you could lose money. Oh gosh, that's not true. You will pay a heck of a lot more over time. So that is a little bit deceptive. You got to have a good plan and a good tax plan.
I'm impressed with you.
Today, we're going to review Dave Ramsey's video where he's asked to clarify what a fixed indexed annuity is. Let's take a listen.
Yeah, how you doing, Dave? A little nervous right now talking to you, but
No troubles. But how can we help?
Yeah, I'm a government employee, and I'm looking to possibly retire this coming year. And currently, right now, I have in my TSP about $1.8 million.
Way to go!
Whoa.
You're a rock star, man.
Yeah.
Okay, so a couple things there. He's looking to retire. He's got $1.8 million bucks. It's not terrible, okay? You can rip through $1.8 million pretty quick.
You're a rock star, man.
Now, again, most of Dave's clients and most of his listeners are a little younger, which is totally fine. You got to have a good plan and a good tax plan because $1.8 million in a TSP, wow, when he turns 72 and he's going to have to start taking RMDs.
Yeah. Wow.
It's going to be vicious. It's going to be not very fun. So he does have some sequence of returns risk at 72 when he has to take required minimum distributions from that qualified. It'll be an IRA because he'll roll it from his TSP into an IRA most likely. But let's keep listening.
Yeah. And with the government, they
you don't sound real impressed with you. I'm impressed with you.
I don't know. It's having that much money. It still makes me a little nervous. But and it's traditional. But yeah, with the government, they provide you with like a financial courses. And one of the guys who gave the course, I guess he's like a financial guy. And I just said, let me just talk to him. And he mentioned something about a fixed index annuity. And I know how you feel about annuities, but this fixed index annuities, he basically gave it a spin where, when the market goes down, it doesn't really go down. And I don't know, I just don't really feel too good about it. And also, too, I did talk to one of the Smartvester Pros, and I'm going to talk to another one.
Good.
To interview them.
Good.
But I just want to know, how do you feel about, I don't know much about fixed index annuities. I did a little bit of research, but I just want to hear it from you.
Okay. Well, basically what we're talking about is an indexed annuity that has a floor to it. It's not going to go below a certain return, probably 5% or 6% or something like that. And it's probably indexed. Typically, it'll be off of something like the S&P 500.
Right.
Indexed means...
Well, so that's partly true. You do have a floor with a fixed index annuity. That's the word fixed, so the floor is zero. If the market goes up, you can participate in the market upside without the downside. I rarely use the S&P 500 because you usually can't get more than a 50% participation rate, which basically means if the S&P did 10%, you would get 50% of the 10, so you get 5. Oftentimes, there are indexes where you can get 100% of what it does without the downside of the market. So he is partially correct.
Means it's not fixed. Indexed means it follows an index. Okay. So, like, have you got your TSP in the C plan? Some of it?
Yeah.
Okay. So the C is an index.
Mm-hmm.
That's an index. So you have an indexed investment now. If you have money in the S plan, that is an index. It follows a small cap index.
That is also partly true. He is in different indexes in his TSP, but unless it's in like the G fund, you could lose money in your TSP. The G fund is pretty conservative, but the rest of the TSP, depending upon which fund you're in, you can lose money, whereas with a fixed index annuity, you do not lose money. If the market goes down, you don't lose a penny.
And so all you're doing is you find a group of stocks that the weighted average of those stocks represent an index. So an S&P 500 is an index, and so it follows that. The problem is not the index, or indexing. The problem is not the floor. The problem is that the annuity fees are double what you get with a mutual fund, and his commissions are 4x what he would get if he sold you the same mutual fund, same index, with.
Okay. Some fixed index annuities have zero fees. In fact, a lot of them do. So that's not necessarily true. Mutual funds, depending on if they're front loaded or not, those can be very high in fees. Oftentimes the expense ratios can be 0.5% to 0.75%. And keep in mind, you're probably paying those if you're keeping it in that strategy for 20 to 30 years. So you end up paying 10, 12% in fees. That doesn't include if somebody's managing your money, which is another 1 to 1.5%. So that is a little bit deceptive. Most of the products, fixed index annuities, don't have fees. Some of them do. They'll have a rider fee. The mutual fund comparison is actually not true. And then he says, well, the person who sold it to you is going to earn 4 times as much on commissions. The commissions are front loaded with an annuity, or you can have it paid out in trails. Oftentimes the commission is not more than 8% to take care of the policy for your lifetime. So if you get 8%, let's say it's $1 million, you'll get paid 80 grand to sell that product. But if you're responsible for taking care of the client for 30 years while they're retired, what you got to do is you got to take that 80 grand, divide it by 30, but you have to manage your cash flow, which is why a lot of annuity companies, they will have it paid out in trails. So you'll get a couple grand each year to take care of the client. The difference is, though, is that the commission is not paid out of your portfolio. You do not pay for that commission. Whereas with a mutual fund, you do pay a fee. So with mutual funds, it is coming out of your account whether your money grows or not. With an annuity, it doesn't come out of your account and you don't lose money. So there is a distinction.
And his commissions are 4x what he would get if he sold you the same mutual fund, same index, without it being in an annuity. And so this guy wants a commission. You need to run.
Oh gosh. See, listen, most people, when they have 1.8 million or more, they don't want to lose any more money. And you can lose money if it's in that index without the floor. There's a trade-off. There's always a trade-off with an annuity. The trade-off is you're giving the annuity company time to play with your money, and in return, they're giving you valuable guarantees that you couldn't get anywhere else. Now, of course, the gentleman who's trying to sell it is trying to make money, but if you actually extrapolate how much a financial advisor makes versus how much a safe guy would make on the annuity side, the financial advisor makes 8 to 10 times as much. And there's another video that we've done where you can see the differences, and we do a breakdown. A financial advisor will earn 8 to 10 times as much than if he were to sell you an annuity, which is why Dave, who primarily sells leads to financial advisors, as well as his Smartvester Pros, they want to keep your money in the market because they'll make more. This is a red herring. Yes, he may make a commission that is sizable, but if you actually break down how much those guys make with fees and with the expense ratios in the form of commissions, financial advisors who invest your money in the market make a heck of a lot more than by selling an annuity.
Okay. I kind of got that feeling, but I said, let me talk to someone, but I just didn't feel right about it.
Trust your feeling.
Yeah, your feeling was right, but that's all it is. It means it's a conservative way that gives you a floor, but you're paying dearly for it. It's not the end of the world. It's not an absolute horrible product. It's not as bad as like Whole Life or something like that, but it's not as good as just a group of mutual funds with your Smartvester Pro, which will have much lower fees. They make much less commission on you doing that.
That's not true. Notice how he wants you to invest with his Smartvester Pro in mutual funds, and yes, you will pay a heck of a lot more over time. So that's not necessarily true. If you guys would like to learn more about the breakdown of how assets under management or financial advisors get paid investing your money in the market versus selling an annuity, you're going to want to check out this video above. I look forward to seeing you then.